My name is Alex Morgan, and I've been tracking commodity markets for over a decade. I've watched gold climb from $1,200 an ounce. I've seen it break $2,000. I was right here when it shattered $3,000, then $4,000. And today, right now, as you are watching this, gold is trading above $5,154 per troy ounce. That is not a typo. That is not a forecast. That is the live spot price as of this morning, February 24th, 2026. But here is the question everyone is asking me right now. JP Morgan, one of the most powerful financial institutions on the planet, has just come out and said gold could hit $5,400 an ounce. So the real question is, should you be buying gold right now? Or is this the kind of rally that punishes latecomers? Stick with me because in the next 20 minutes, I am going to walk you through the freshest market data available today, break down exactly what is driving this rally, explain what JP Morgan's analysts are actually saying and why, look at the technical picture to understand where price is likely to go next, and then give you my honest take on whether this is a buying opportunity or a danger zone. Let's get into it. Let me start by grounding everything in numbers, because I don't want to speculate. I want to show you what the market is actually doing right now. As of this morning, the live spot price of gold is $5,154.31 per troy ounce. To give you context, that works out to $165.71 per gram. A single kilogram of gold is now worth over $165,000. We are in genuinely historic territory. Just yesterday, February 23rd, gold surged 1.7% in a single trading session, briefly touching $5,191 per troy ounce. Why? Because markets got hit by a fresh wave of uncertainty around U.S. tariff policy. A new temporary import duty was announced under Section 122 of the Trade Act, framed as a response to international payments imbalances. That kind of policy shock, sudden, unpredictable, economically disruptive, is exactly the kind of environment where gold thrives. According to Light Finance's analysis published today, gold is currently trading at $5,132.92, with tomorrow's projected price range sitting between $5,153 and $5,208. The range matters because it tells us the market is still expecting movement, volatility is elevated, and that often precedes a decisive directional move. Now, let's look at the bigger picture. Gold closed above $5,000 for the first time last week, and crucially, it held that level through the weekly close. That is significant. $5,000 was a round number that many analysts expected to act as strong resistance. When a market punches through that kind of barrier and then holds it, it sends a clear message to institutional traders. The buyers are in control. What you need to understand is this. We are not in a speculative bubble driven by retail enthusiasm. This rally has legs because it is being driven by some of the most powerful and fundamental forces in the global financial system. And that is exactly what I want to explain next. When gold moves this aggressively, it's never just one thing. It's a confluence of forces. And right now, there are four major drivers all pointing in the same direction. Force number one, trade policy chaos. The unpredictability of U.S. trade policy is arguably the single biggest driver right now. Investors and institutions hate uncertainty. When they can't model the future with any confidence, when tariffs can appear or disappear overnight, they turn to gold. Gold is the one asset that doesn't depend on any government's credit, any company's earnings, or any central bank's promise. It just exists. And in a world of policy chaos, that is enormously attractive. The announcement this week of new temporary import duties has rattled supply chain managers, inflation expectations, and growth forecasts simultaneously. When all three of those things go into the red at the same time, gold goes up. That's not speculation, that's history repeating itself. Force number two, the Federal Reserve is boxed in. At its January meeting, the Federal Reserve held the federal funds rate steady at 3.50% to 3.75%. Right now, according to CME Group's FedWatch tool, 92.1% of traders expect the Fed to hold rates unchanged again at the March meeting. Only 7.9% are pricing in a cut. Now, some of you might be thinking, if rates stay high, doesn't that pressure gold? In theory, yes. Higher interest rates make bonds more attractive relative to non-yielding gold. But here is the nuance. The 10-year Treasury yield currently sits at approximately 4.08%, while 10-year inflation-indexed bond yields, the so-called real yields, are around 1.80%. That real yield is still historically low relative to the uncertainty in the system. And when you factor in the inflationary risk of new tariffs, the real purchasing power of those bond yields starts to look less attractive very quickly. The Fed is caught between inflation risk on one side and slowing growth on the other. That's a policy trap, and historically, policy traps are very good for gold. Force number 3, geopolitical risk is elevated globally. We cannot ignore the geopolitical backdrop. Ongoing tensions related to the Ukraine conflict and persistent disruption to Red Sea shipping routes are keeping global risk premiums elevated. When shipping routes are unstable, supply chains are under stress. When geopolitical tensions are high, sovereign wealth funds and institutional investors rotate into safe haven assets. Gold sits at the very top of that list. It is worth noting that these geopolitical forces can fade fast. A ceasefire announcement, a diplomatic breakthrough, or a calming of rhetoric can trigger a sharp pullback in gold. That's a risk we need to keep in mind, and I'll come back to it in the risk section. Force number 4, central bank buying, the biggest structural story. This is the one that doesn't get enough attention on financial media, so I want to spend a moment on it. Central banks around the world bought 863 tons of gold in 2025. That's not a typo, 863 tons. And in January 2026, the People's Bank of China made gold purchases for the 15th consecutive month. The PBOC, 15th consecutive month. What does that tell you? It tells you that the world's most sophisticated institutional buyers, central banks whose job is to protect national wealth over decades, are systematically adding gold to their reserves. They're not trading it, they're accumulating it. That is long-term, structural, price-supportive demand, and that demand is projected to continue at roughly 850 tons in 2026. Now let's get into the headline that brought you to this video. JP Morgan, one of the most influential financial institutions in the world, has issued a forecast that gold will average $5,055 per ounce by Q4 of 2026. But more strikingly, their analysts see gold climbing toward $5,400 per ounce by the end of 2027. Let me be very clear about what this means. JP Morgan is not saying gold is going to magically teleport to $5,400. They are laying out a macro thesis backed by continuous institutional demand, which they estimate at around 585 tons per quarter from investors and central banks combined. That is a sustained, persistent flow of capital into gold that keeps a floor under the price even during corrections. JP Morgan's thesis aligns with what Metals Focus, an independent precious metals consultancy, is also saying. Their forecast sees gold reaching as high as $5,500 in 2026, even more bullish than JP Morgan. Metals Focus specifically noted that the level of gold being sold back into the market has been very modest, which means there is limited supply pressure from profit-taking. That's a key insight. If big holders aren't selling, price has to go higher to find new supply. The World Gold Council has also weighed in. In a more severe economic downturn scenario, think deeper recession, collapsing bond yields, intensified geopolitical stress, the WGC estimates gold could surge 15% to 30% from current levels in 2026 alone. At the top end of that range, we'd be talking about gold approaching $6,700 per ounce. That is an extraordinary scenario, but it is one that credible, mainstream analysts are putting on the table. The bottom line from the institutional world: the consensus is bullish. The disagreement is only about how bullish and how fast. Now let's look at the chart. Because regardless of what the macro story says, price action always has the final vote. On the weekly chart, gold closed last Friday with what technical analysts are calling a bullish hammer-like candle, a candlestick pattern where price dips during the week, but buyers step in and push it back up near the highs by the close. This is a classic sign of buyer strength. It tells you that every time sellers tried to press price lower, someone was waiting to absorb that selling and push it back up. The breakout above $5,100 is also technically significant. That level capped price earlier in February. It acted as resistance. When resistance breaks and holds, it converts to support. So now $5,100 is a floor that bulls will defend aggressively. Looking at today's intraday structure, gold has reached what technicians call the gold zone, a key resistance cluster sitting between $5,249 and $5,271. This is a decision point. If bears can hold price below this zone, we could see a short-term pullback or consolidation phase. The first meaningful support level sits at $5,036 to $5,015, and below that, the critical $5,000 psychological floor. Key levels to watch on the upside: $5,208, $5,266, $5,320, and $5,370. If gold can break and close above $5,271, the next major target becomes $5,370, and then the psychological $5,400 level that JP Morgan has in their forecast. The MACD indicator is currently declining in positive territory. What that means in plain English is this: gold is still in a bullish trend, but momentum is losing some steam in the short term. Mixed signals. That is not necessarily bad. Healthy markets consolidate before continuing higher. But it does mean that a breakout from this zone is not guaranteed this week. This is the part of the video I know you've been waiting for. So let me lay out 3 scenarios for where gold goes from here: a bull case, a base case, and a bear case. And I'll tell you which one I think is most likely. Scenario 1, the bull case. Gold breaks $5,400 by mid-2026. In this scenario, tariff uncertainty continues or worsens. Inflation expectations tick higher, forcing the Fed to stay on hold longer than the market wants. Central bank buying accelerates. ETF inflows surge as retail and institutional investors pile in. The PBOC and other emerging market central banks continue their systematic accumulation, and the geopolitical situation remains unresolved. Under these conditions, gold breaks cleanly above $5,271, clears $5,370, and tests $5,400 within the next 2 to 3 months. This scenario aligns perfectly with JP Morgan's forecast, and metals focuses even more bullish $5,500 target. Scenario 2, the base case, consolidation between $5,000 and $5,300. In this scenario, which I think is actually the most probable outcome over the next 4 to 6 weeks, gold enters a period of sideways chop. The big institutional buyers stay in, but profit-taking from short-term traders creates a ceiling around $5,208 to $5,270. Periodically, we see sharp dips back toward $5,000 to $5,036, which get bought aggressively. The market essentially digests its enormous gains before deciding whether to push higher. This is healthy action. It builds a base, it shakes out weak hands, and it sets the stage for a much more durable breakout when it comes. Scenario 3, the bear case, a correction back toward $4,700 to $4,900. I have to give this scenario its due respect because markets have a way of humbling overconfident bulls. If geopolitical tensions suddenly de-escalate, if a Ukraine peace deal materializes, if tariff threats get walked back, the fear premium in gold could evaporate quickly. Add in a stronger US dollar, a hawkish surprise from the Fed, or a spike in real yields above 2%, and gold could correct sharply back toward the $4,700 to $4,900 range. This is a real risk. It is not my base case, but it is entirely plausible. All right, here is where I give you my honest, unfiltered perspective. And I want to be very clear up front. Nothing in this video is financial advice. I'm an analyst and a market commentator. You need to make decisions based on your own situation, your own risk tolerance, and ideally in consultation with a qualified financial advisor. With that said, here is how I think about this. Gold at $5,154 is not cheap. We all know that. Anyone who bought at $1,200, $2,000, or even $3,000 is sitting on extraordinary gains. But the question you need to ask is not, is it cheap? The question is, are the conditions that drove it here still in place? And when I look at the data, the tariff uncertainty, the Fed's constrained position, the geopolitical backdrop, and above all, the relentless central bank accumulation, the answer is yes. The structural case for gold is intact. If you are thinking about initiating a position right now, I would not chase gold in the current resistance zone between $5,250 and $5,270. Patience is your edge here. If we get a pullback toward the $5,000 to $5,036 support zone, which my base case scenario says is very possible, that would be a far more attractive entry point with a clear stop-loss level below $4,961. If you are already holding gold, congratulations. The question for you is whether to add on strength or wait for a dip. Given the technical signals showing weakening momentum near resistance, waiting for a pullback to add makes more sense to me than buying into a potential short-term top. And if you have zero gold exposure, think about your overall portfolio. Gold is historically one of the best diversifiers against inflation, currency debasement, and geopolitical shock. A 5% to 10% allocation to gold or gold-related assets, whether that's physical metal, gold ETFs, or gold mining stocks, has historically reduced portfolio volatility during crisis periods without significantly dragging on long-term returns. Before I close out, let me flag the key catalysts you need to have on your radar right now. Because gold's next major move is going to be shaped by what happens in these areas. This week, watch for Fed speakers. Multiple Federal Reserve officials are scheduled to speak, and their language around inflation, growth, and the rate path will directly move gold. Any hint of a more dovish stance, even a subtle softening in tone, could be the catalyst that pushes gold above $5,271. Any hawkish surprise could trigger a swift pullback. Initial jobless claims data comes out this week as well. Strong employment data tends to support the Fed's case for keeping rates higher for longer, which is mildly negative for gold in the short term. Weak data does the opposite. Keep your eyes on the US dollar index. Gold and the dollar typically move inversely. If the dollar strengthens against a basket of major currencies, it will create headwinds for gold, particularly for international buyers. A weakening dollar, on the other hand, would amplify gold's upside. And of course, any further tariff developments or geopolitical headlines could move the market suddenly and sharply in either direction. In today's market, you need to be alert. Not reactive, but alert. Let me bring it all together for you. Gold is trading above $5,154 per ounce as of today, February 24, 2026. It is being driven by a powerful combination of trade policy uncertainty, a constrained Federal Reserve, elevated geopolitical risk, and, the big one, relentless central bank buying led by the People's Bank of China, now in its 15th consecutive month of accumulation. JP Morgan sees gold reaching $5,400 by end of 2027. Metals Focus sees $5,500 in 2026. The World Gold Council sees as much as 30% upside in a severe downturn scenario. Technically, gold is at a critical resistance zone between $5,249 and $5,271. A breakout above that zone opens the door to $5,370 and $5,400. A failure there could pull price back toward support at $5,015 to $5,036, which, from a buying perspective, might be exactly the opportunity you've been waiting for. The structural case for gold is as strong as I have seen it in years. The short-term picture calls for patience and discipline, and the macro environment, with all of its uncertainty, all of its geopolitical tension, all of its central bank maneuvering, continues to build the foundation for a higher gold price over the medium and long term. I'm Alex Morgan. If you found this analysis valuable, hit that subscribe button so you get every future update. Drop a comment below. I want to know, are you bullish, bearish, or sitting on the sidelines with gold right now? Tell me your position. Until next time, stay sharp, stay disciplined, and I'll see you in the next video.